we're growing concerned. And that's one reason we reduced our exposure by about 6 or 7%.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of the week for another weekly market recap, this time featuring my good friend, the portfolio manager, Mike Lebowitz. Lance Roberts has the week off. Mike, how you doing?
Doing great. How about you, Adam?
I'm doing good. I'm doing good. As you said right before we turned the camera on, this will probably be pretty quick. Not too much going on right now. Said obviously with a heavy tongue in cheek. So a lot has happened since last week's update with Lance. First and foremost is the outbreak of war between the U.S. and Israel against Iran. And it's having a lot of implications. Right now, the price of oil is spiking, I believe, to multi-year highs here. Um, Iran, in response to the attacks by the U.S. and Israel, has been threatening to choke off the Strait of Hormuz, and not much is going through there right now. The world's really beginning to panic about that in terms of flows of oil and other things through there. This morning, President Trump posted a Truth Social note basically saying there's no negotiation possible with Iran until they're willing to discuss unconditional surrender. I think that was the trigger for the latest jump in oil, at least as of the day that we're talking here, Mike. Stocks are down. They have been in a trading range, which Lance and I talked a bit about last week, pretty much since October of last year, Halloweenish or so. Stocks really hadn't been able to break out of the sideways trading range. Lance was looking at a lot of, technical levels and, saying, okay, look, if it goes above here, that'll be a breakout to the upside. If it goes below here, that'll be a breakout to the downside. I'm curious when we get to the TA here for today's talk, Michael, whether we're seeing any technical breakdowns that make you and Lance more nervous that this consolidation might end in a breakdown. Maybe it was just a topping process all along. Don't know if we're in that danger zone yet. But like I said, lots to talk about. Of course, we've got some really interesting new data out too around jobs and things like that. But let's start with the war. Um, as you guys at RIA who are managing capital and have to preserve client capital, what's your status right now? Are you still as invested as you've been? Are you starting to take more defensive measures?
So over the last few weeks, couple weeks, we brought our exposure. We were slightly overweight our benchmark. We brought it back down to regular weighting. Um, as I'm going to show you in a little bit with the charts, the market really continues to just trade in a trend. Uh, Part of the problem is that trend is kind of an arc-like shape.
Hmm.
You can draw a rectangle, and I'm going to do that, but there is an arc-like shape to it, and we're on the right side of that arc. So that is a little concerning. But thus far, we really haven't gotten any good technical signals to say start reducing, get out. At the same time, our portfolios are sitting near their all-time highs. On what's today, Friday, we closed out Wednesday at our record high. So our exposure to different sectors and diversification and the way we've kind of moved around value growth, large cap, small cap, with not just defensive in the finance way, but defense stocks, the Palantirs, RTXs, has really helped the portfolio uh, reduce the volatility and pretty much stay up at our highs. Um there's a lot of within the portfolios, a lot of winners, a lot of losers on a daily basis. But as you know, we always tell our clients to look at the bottom line. We build a portfolio to affect the bottom line. And what we're finding so far, fingers crossed, is that we are pretty well hedged. And that said, we have no problem reducing exposure when those technical signals trigger or, potentially other things happen.
Okay, so we'll get into this in a bit, but it sounds like those technical triggers at least, to the downside where it would force you to say, okay, look, we got to lighten up here. You haven't seen them yet, but it sounds like you're watching the tape closely. I want to thank you and your colleague there, Lance, for demonstrating what this was the vision when we started these weekly market recaps with you guys, of just giving viewers a very transparent view into how quality financial advisor manages money for clients in good times and bad. So obviously, this is one of those times where diversification, is really playing its role. Lance and I talk about what makes a really good capital manager is the willingness to be unsexy, right? To do the things that are kind of boring.
I don't think that's a compliment.
Well, at the end of the day, it is if you're getting the returns that you want to get. Lance was saying, coming into this year, hey, here's a whole bunch of reasons on why we're starting to increase our exposure in the portfolio, move a little bit away or take a little bit out of the hyperscalers and the AI trade that's been doing so great. And we're going to feed a little bit more some of these, sort of value beaten down parts of the market that have been unloved. And, in the time you're doing that, you don't get a lot of kudos for it, right? Because people are saying, wait a minute, this thing's been red hot. Why are you getting out of the red hot thing into these boring things? Well, for these exact reasons. And again, I just want to commend you guys for doing it, being willing to take the slings and arrows while you're doing it, but keeping this audience informed of what you're doing, because you're really showing how an experienced, framework-based, logical financial advisor, practices their craft.
Right. I remember we got an email from a client back in November, December. We got the email the day we added to Walmart. We had Walmart already and we added to it. And he goes, why do we own this dog? Walmart has been one of the most red hot stocks within the staples sector since pretty much the day we got that email. So, I guess to your point, owning Walmart isn't very sexy, but it gets the job done. The other thing I would say that really helps Lance and myself are the gray hairs. It's the 30, 35 years plus being involved in the markets and watching financial crises, geopolitical crises, all kinds of events that shake markets. And having lived through so many different types of things, you gain an appreciation to, for lack of a better word, to avoid what your gut's telling you and
Mhm.
focus on the data, focus on your technical analysis, your fundamental analysis, whatever your analysis is, and not let that feeling in your stomach or that voice in your head kind of get you out of positions or put you in positions depending on the different scenarios. So, I think we can attribute a lot to our systems, our processes, our mindset, but you need to give equal credit to the experience. I think it's critical in times like this. The last couple of years, that experience was nice, but not as valuable as it is today when there's a lot going on and it's very easy to get freaked out.
Yeah. And we talk about this all the time. For most investors, most retail investors, especially the DIY crowd, oftentimes your worst enemy is yourself, right? It's
Mhm.
your emotions getting you into problems you shouldn't get into. And that's why not only the experience you're talking about, but the framework, right? The having a framework that you can look at data and say, okay, look, no matter what my emotions are telling me, the framework that I've invested in and built over years from my experience is telling me to do X, and that's what I'm going to lean into. All right, so back to the topic of the war. Whenever there's something geopolitical going on, I'll take pains to ask Lance about it when I know what his answer is usually going to be, which is it's kind of a nothing burger to the markets at least. The markets usually are pricing in what's more likely to happen, or they've got some, they've priced in every scenario and it's been weighted by whatever probability the market forces give it. But generally, big geopolitical developments don't really change the market that much. Maybe they'll roil it for a day or two, but things will kind of equilibrate. Is that the case here this time? And I ask because this conflict is really impacting, or looking like it's going to impact the flow of oil around the world. And that is something that can have, a very demonstrative impact on the global economy.
Yeah. I mean, the problem with these events is they're very short term. All of the assets that we're purchasing are very long term. We're looking at streams of cash flows that are priced based on the next 5, 10 years. And we're
Mhm.
looking at an event that could be days, could be weeks, could be months, could be longer. Like we don't know. Um, so that's number one. Remember what you own, whether it's a bond, whether it's stocks, whether it's some other asset. They're long-term assets that that are not really impacted. How much is Nvidia or Apple or Clorox's earnings really going to get impacted because oil is high for 2 months? The answer is some companies, very little. In some, there will be an impact. But you have to kind of focus on the longer term, understanding what's going on. Oil's a tricky one, right? Because this geopolitical crisis revolves around oil, and Iran is a major producer, and B, they run the toll booth at the biggest waterway that really moves oil to the east and to Europe. So it's a very important chokehold that they potentially have on the market. So what does higher oil mean? Well, it does. There is it's not as strong a correlation to CPI as you would think. We actually just put that in our daily commentary. I think it was today, Fridays or maybe Thursdays. The R squared, looking at changes in oil to changes in CPI is only like 0.20. So there's a correlation, and if you plot it out, you can see the relationship, but it's not great. Second of all, how does higher oil prices impact the economy? Yes, CPI will raise because of oil, but if we spend more on gasoline and energy, we have less to spend on all the other stuff in our
Right.
life, going out to dinner, going to the movies, buying a car, whatever it may be. So there's a natural drag that's also going on prices. And that's why the relationship between one component of CPI, oil, to CPI as a whole is not as strong as you would think, given how important energy is to the economy and to, prices in general. Second thing is, what does the Fed tell you every time? Whenever they quote CPI or PCE or PPI, they quoted core. Core PCE did this. Core CPI did that. Core excludes food and energy. And they do that, and it's kind of crazy, right? Because that's all we spend our money on is food and energy. But they do it because there's so many external impacts or factors that drive those prices that are out of the Fed's control, right? Weather. Weather had a huge impact on natural gas prices. There's nothing the Fed can do to change the weather and get natural gas prices to quote unquote behave. Same thing with the Iran war or with crops or with cattle or with so many different other things. It's out of their control. So the Fed looks beyond kind of temporary rises in commodity prices in general. Second of all, let's go back to 2008. The Fed cut rates as the price of oil shot up from 80 to 150. In the first quarter of 2008, they cut rates 1 full% as oil was going over $100 a barrel. That's still, what, about $15 above where it is today, and it was on its way to almost 150. The Fed never raised rates despite oil getting up to 150. And then it kind of got us to September, October, and they had to deal with the financial crisis. Oil plummeted, rates plummeted, but I think it's what the Fed's telling you by that is that oil prices are they're important. I'm not going to say they won't tell you they're important, but it's something they're willing to overlook, especially when it's event driven and that event timeline is unknown and not likely to be as it could be a very long timeline, but the impact it'll have on oil could be very short.
All right, Michael. Look, I want to ask you a couple questions here about oil. So I'm going to bring up this chart, which is this chart of the price of oil. This is West Texas, and you can see that it's basically exploded higher since the outbreak of the war with Iran. It was at about $65 a barrel beforehand. Now it's pushing $90 a barrel. So this is the squeeze that we're talking about right now that the world is reacting to, the oil price shock. How much higher it goes, who knows? But let me contrast that with this chart here of the XLE, which really hasn't moved that much, certainly not in the way that the price of oil has since the outbreak of hostilities in Iran. So I got two questions for you. One is, why not? Why are we not yet seeing the oil and energy sector stocks respond to the big jump in oil right now? And then secondly, if you look at the price of the SLE here, back in Q4, I was talking with Lance and you, I believe, about how a lot of folks that I've been interviewing have becoming increasingly bullish on the oil and gas sector. And, certainly oil stocks, have really underperformed for a lot of years. And they were beginning to say, hey, we think this thing may actually start to turn. And you can see here at the start of 2026, the XLE really started to move. I'm just curious, is there any way here that the complex sort of sniffed out the likelihood of the US going to war in Iran? Or is this really just coincidental that the industry was just starting to turn and then everybody, including the industry itself, got surprised by this?
I think it turned with value, right? Why did regional banks do so well over the last 6 months? Why did, the market rotated from growth to value in November-ish of last year. Energy stocks are one of the deeper value sectors. They're kind of always known as value. And not surprisingly, they took off while the price of crude oil was languishing. And, we've written about this. I don't know if Lance talked to you about it, but the price of energy stocks had gotten well above where they should be given what's going on with the price of oil.
Yeah, he had been warning about that. Yeah.
Right. And so you get to this event and the market's like, you're already very extended in price. There's not much more. They've been trading better in the market, but your upside is when you get valuations, and that's another way of considering valuations. Valuations so extreme, so high, it's hard to get more upside. And that was one of our chief concerns going into this year, is that valuations are high and therefore the amount of upside is limited. And I think that's what we saw with energy. The other thing is, okay, let's buy Exxon. What are we looking at if we want to buy Exxon? I want to know what their earnings are going to be going out to 2030, 2035. Will they have a blip positive in earnings in 2026 because of this? Maybe. They hedge. They don't they don't just leave their earnings up to the whims of the oil markets. They hedge a good chunk of it. So a lot of these gains won't flow through to the bottom line because they're hedged. Second of all, you want to go back, let's look at Clorox in 2019 to 2021. Clorox was, Clorox is the most boring stock there is, very slow growth. That stock almost doubled during the pandemic because demand was literally off the shelves. You couldn't
Right.
buy
We were
Clorox.
bleaching everything. Yep.
Right, right. Even ingesting bleach, as our
As
president
some
told us to do.
suggested. Yeah.
Right, right. But bottom line is it helped their sales for a quarter or two, and the stock is now well below where it was at the eve of the pandemic. So, the point is that we're looking at streams of cash flows, and those cash flows are hedged against changes up and down in the price of oil. So the impact on this over any kind of scale earnings is going to be minimal, barring any kind of outlook or events that we just can't foresee that permanently raise the price of oil. I just don't see that today.
Okay.
So
I mean, that
so
explanation makes a lot of sense.
energy stocks came in very overvalued, and you basically had priced in, knowingly or unknowingly, what was happening.
Okay. All right. That actually makes total sense to me. All right. So anything else you want to say about the war and its potential impact on markets before we transition to the regular technical analysis, what's going on with the S&P?
Yeah, it's kind of an important behavior. I guess we'll throw it under the behavioral file. I don't know which file you put it under.
Mhm.
Markets know everything there is to know. Doesn't mean they don't get surprised by events, but everything there is to know is priced into markets at any time. So if you think that the war is going to be different, you just need to know that the market, or if you think, 3 weeks ago, you think that something's going to happen and the market is aware of that, it is priced in. Energy was priced in. So you have to think something differently than what the market is scared of to really think the market is going to fall a lot or rise a lot. And I think investors don't realize that a lot of news, what becomes news, is known by some people beforehand. And when that happens, the market prices in. Its price is already adjusted for what may happen, for the odds of what may happen. So I think as you're thinking about the worst case scenarios, the best case scenarios, they are all partially priced in. And as they come to fruition one way or another, the price will move accordingly. But there are people that are trading these markets that know more than you, and they're impacting the price. So, from a kind of broad point of view, it's important to understand that.
Okay. And so just to sort of make that actionable, what's your advice to people then?
That you have to be careful about these doomsday scenarios regarding the war. You have to be careful about a scenario that it's going to end in negotiations this afternoon and everything's going to be hunky-dory. You have to accept that the market is pricing in what has happened already. And if you have a forecast that's very different than the market, you potentially have an advantage, but it's a forecast. You don't know more than the market. So you have to, A, have a forecast that's different and be right. And if
Yeah.
you are, you want to put some money on that bet, that's fine, but realize you're going against the tide
Okay. And
current.
kind of what I hear you say is don't be too cute trying to predict what's going to happen geopolitically,
Well,
whether there's going to be a truce or how it's going to end up, whatever. More sort of trade the markets we have, rather than try to, try to out predict the people who know more than you in this situation.
trade the market you have. And when I say that no more than you, I'm not talking about financial people, guys that work at JP Morgan or Goldman Sachs. There are people that are politically hooked up, that are in Iran, that are in the Middle East, that are talking to Israel, that are talking to our government, that know what's going on. And they're talking to the biggest investors in the world. So people have a much better idea than you can ever get from CNN or Fox,
Yeah.
or whatever paper you read.
And that's kind of interesting, which is, look, I mean, the powerful are always, there's always going to be an information asymmetry, between the really big investors and everybody else. I think one can argue that asymmetry has maybe reduced a bit with the advent of all the digital information that's out there, and hopefully programs like this one that bring in really smart analysts to share their expertise with the average person, whereas 20 years ago, the average person really didn't get, much access to that. But when you have periods of intense disruption like now, the value of information asymmetry is even greater. And these are people that have contacts, and again, not just in the financial world, geopolitically, et cetera, who can kind of pay for that information. And there's a lot in a time like this where even our government is not sharing the full story with us in many ways because they can't, right? They don't want to show their hands to the world if they're trying to affect some sort of larger, grander campaign goals. But there are very rich people who are politically connected or otherwise who can get access to at least some of that information, which gives them a more substantial leg up than they normally have over the general market participant.
Exactly. So you said it best, trade the market you have. Um, I mean, that's just the advice. And it's, again, kind of don't let your gut or that voice in your head sway you to do things that are not, that are um, abrupt or, that kind of go against really what you should be doing. Stay your course, have rules, understand what your rules are, be vigilant, and if you break the rules, sell. Like Lance and I had a long discussion this morning. What does it take to start reducing exposure? And we didn't talk about, well, if Iran does this or Israel or the US does that or the Fed. We talked about technical levels, lines in the sand, technical events occurring. Um, so have that conversation with yourself. If it helps you, write it down on paper and put that sticky on your computer and watch it, follow it, and live to your rules. You know, don't when you get there and you get a rule that's been broken, say, but something positive is going to happen this weekend. I'm better off not listening to my rules. So
Mhm.
that's kind of the advice I would give.
All right, well, that's a great segue to the next section here of looking at the S&P and looking at the technicals. Um, Michael, I asked Lance this last week exactly. Hey, what are the things you and Michael are going to need to see to conclude that it's not a consolidation? The past bunch of months haven't been a consolidation that's about to spring higher. That instead, oh, it's been a topping out process that's now starting to roll over. So I'd love to hear what the outcome of your discussion this morning was with Lance about what specifically would you look for to say, okay, we got to start lightening up.
Okay. So I put together a beautiful presentation for you, and
Thank you.
I'm going to start with bonds. And I'm going to end up with stocks.
Okay,
And I actually want to talk a little bit about value kind of once we get through some of the technicals as well.
sure.
Um, Let me share my screen. So let's just start with bonds because I know you're going to ask me eventually. So let's talk about what's going on with bonds. Bonds were trading well. The 10-year bond got below 4% right before Iran hit. So right now, what you're seeing are 30-year bond futures. It's a proxy for bond prices, not yields, prices.
Yeah. So as
And
yields go up, the price goes down.
and vice versa.
Yeah.
Right. So you can see that the 30-year bond has gone from about 119 to 116-ish, about 3 or 4 points. Um, Yields have risen, right? The 10 years around what, 415-ish, I think.
Hmm.
It was slightly below 4 before this started. So
And Michael,
bonds are
that's a little
strong.
contrary to people's expectations, right? Oh, there's chaos in the world. Capital is going to seek safety and it's going to go into treasuries, but that's not happening this time, right?
Well, the problem with this war is that the market perceives higher oil prices as inflationary, which is bad for bonds. And it knows this isn't perception or forecast that we now have higher deficits because of this action. How much, how long, we don't know. But what was already a troubling deficit situation by necessarily has gotten worse. And bonds, I think, are reflecting more of that than the flight to quality.
Hmm.
Um, Even today, we got the employment number was a very weak number, and bonds are slightly higher in yield. So that tells me that the market is looking at Iran and the negative inflationary deficit implications than the economy, uh, which is that's very helpful to know in this market what's driving, because you can kind of use bonds as a proxy for other markets. Well, here's what the bond market's thinking. So some of that same thought process is working through stocks or gold or the dollar or whatever other asset you're looking at.
Hmm.
But what I want to show here is that you can see these two light blue lines. We've been trading in a channel. I mean, you're going to see it in the stock graphs too. We've been trading in a channel, in this point, about a 6 point channel since about September. And really, they've been going sideways since more or less the beginning of 2025, kind of up and down. This black line shows there is a positive upward sloping trend line that the trend generally has been towards lower yields. It's just been kind of whipping around. Hasn't been volatile, but it hasn't been just a nice steady line upwards either. The
Right.
yellow
And
line is
like
kind of
stocks
the mid,
since October, pretty much range bound.
very much. I mean, even if you go back to March of 25, you got the little spike around the Liberation Day, but other than that, it's been in a similar range. Um, So, looking at it technically, we're coming up on the 200-day moving average. It's sitting right on top of it. We got this lower trend line that should support it. But we're in a period of consolidation, and the typically consolidations end up with a breaking out or breaking down. So, like everything else, that's what we're looking at for bonds. Its RSI is pretty low. It's getting oversold, not grossly oversold, and its MACD just went on a sell signal. So some of this downward pressure in bond prices or upward pressure in yields may continue. Now, it may just be time. We just stay where we just kind of slowly move around where we're at now, let the indicators become a little more bullish, then we rally, or there's something really going on here and bond yields start taking off. But these are kind of the technical gauges we're looking at here. The 200-day moving average hasn't been a great support resistance, but we would like to see it stay up, within a point or so of the line. It's not a hard and fast rule, the number itself. And we don't want to see it breaking lower lows, which is, call it 114. So another 2 points below where we're at.
Hmm.
Um, on the upside, if it can get above that light blue line, 120-ish, we can, make a case that yields are going lower. So some of this is just how does the bond market interpret what's going on with Iran and in conjunction with the recent employment data, with CPI coming out on I think it's Wednesday. And I'm going to diverge a little bit here, but bonds are highly correlated to inflation. So right now you got the oil inflation narrative seeping in. But we've been talking for a few months about Trueflation, which has shown prices plummeting. Their
Hmm.
inflation gauge is below 1%, and their inflation gauge has a very high correlation with CPI. So the question in our mind is not whether CPI is going up 0.8%, because it's not in the next 2 months. But what is Trueflation picking? Why is Trueflation picking up such a sharp decline in prices? And will that flow through to CPI in time? Because we know CPI lags Trueflation. So this CPI report is kind of our first look at this will be for February. Trueflation started dropping almost on January 1st. So we may get a hint of it in this report. If not, the next report will show it or it doesn't show it, and Trueflation is just off. But the two have been so highly correlated, that is just something to keep an eye on when you're weighing what could push this out of its range, upward or downward.
Okay. So
Uh, so
couple quick questions here for you. One, it seems like what you're saying here is in addition to the price action we've had, it seems the current interpretation of the bond market is, hey, there's going to be at least near-term inflationary repercussions from the war, the increase in the price of oil, et cetera. Therefore, it wouldn't shock you if bond uh, prices continued downwards a bit from here. But over the past year or so, probably longer, but definitely in the past year, you and Lance have said, hey, our general analysis leads us to believe that, over the course of the next year or so, um, inflation will continue to disinflate and bond prices will rise as yields come down as a result of that. Is that still your default assumption here, or is the more recent math changing your opinion?
No, I think inflation's heading back to 2% or even lower.
Okay.
I think the change, what's happened in bonds the last few days is less about the inflationary aspect and more about the deficit aspect. And that's we've talked about before. That's the term premium fear, is that deficits keep rising and the bond market just has to deal with this supply of bonds in the market. Investors then demand higher yields and yields go higher. So I think the market is more concerned about the cost of war in addition to all the other spending. And that's why, bonds are trading lower today despite employment because there's really all of a sudden what went from looking like a 1 week war is looking like a war that's going to be extended. How long? We don't know. So I think when you think about what's going on in bonds, think more deficit than inflation.
Okay.
But right now, and look, this can all change. I think of this as a speed bump uh, on the way to higher bond prices, lower bond yields, and inflation working its way to two
Okay.
or below.
Yeah, and folks, we'll be checking in on this on a regular basis with Mike and Lance. So, if that indeed is what happened, or if something else happens, we'll be giving you real-time updates along the way.
So so while we're talking about bonds, what's been in the news has really been private credit. That's been a kind of bigger topic. So, one of the things that we know from history is credit spreads tend to be a good leading indicator of the financial markets.
Hmm.
And when we talk about credit spreads, we're talking about corporate bonds. Private credit are loans that were made to smaller companies and they're having issues, delinquencies, defaults, some fraud. We've seen it in Citadel and Blue Owl. There have been MFS defaulted about a week ago. Uh, there were two auto companies, October, November last year, that defaulted.
Nice.
So we
White collar
saw
first brands. Yeah.
BlackRock, right? BlackRock put a gate on their private equity funds yesterday or today. They're only allowing these private credit investors to take out 5% of what they own. Apparently, the demand is for 9 or 10%. So we're seeing gates put on these private credit funds. So it's problematic. But the question is, from us is we're not overly concerned until this starts hitting the corporate credit market. So what I actually have here is a little treat, I guess. This is our new Simplivisor. This is something we're still working on. It's not out there for the public, but we're redoing the face. We're adding some enhancements. We're putting an AI twist on it as well. So I wanted to share a couple screens that are done that help us tell the story we're trying to tell. Um, so what we have here on the left side, or we break it down, credit spread. So let me start over. What does a corporate bond yield? Say a 5-year triple B corporate bond, what does that yield? And what does a 5-year treasury bond yield? That difference is the spread. And the wider the spread, the more risk the market is pricing in. The tighter, the more complacency the market's pricing in. So we can just kind of focus on this triple B line. Right now, you get paid 103 basis points more than a treasury to buy a triple B corporate. This is an index, so every bond's a little different, but the index is about 1% more over treasuries. So that what does that mean? That doesn't mean much, but we need to go back and look at history. And history tells us that over the last 20 years, that's in the lowest 3 percentile. It's basically at all-time lows. It's very tight, as you say, in the bond market. But as we look over the last 3 months and even the last year, it's in the upper half. So spreads are widening. They're not as tight as they were. You can see as you go down to like single C and B, these are junk bonds. They are basically around the highest they've been in the last year, give or take a little. Um, Down at the bottom, we have triple B graphs, and we separate them out, both short term and longer term. And the one on the left is our short term graph. You can see they've been picking up the spread, but it's still not that much, and it's really only back to average um, over the last year. And if you really see this on the 10-year graph, if you look hard enough, I guess you can see it increasing, but you really have to squint your eyes to see it. So the point is, there's a little short-term stress in the credit markets, but it's nothing, nothing like what we're seeing in private credit. That said, these markets can move really quickly. So what we're talking about today, by next Wednesday, could be a very different story. So this is one of those screens I look at every day just to keep an eye on to make sure that kind of that canary in the financial market coal mine is still standing up. Um, so I think as long as private credit becomes an issue with war going on, with the economy a little bit unstable, this bears keeping an eye on.
Okay. So I've been asking Lance about the private credit risk, over the past couple of months as we've seen more and more headlines about it. And he's basically said sort of what you said, which is, hey, I could get worried about it. There's a lot of things I could tell myself to be worried about it, but I'm not going to start to get worried about it until I start seeing visible stress in the credit markets, specifically looking at these credit spreads. Um, so kind of what I hear from you, Michael, is you're worried enough about it that you're watching this thing on a daily basis, but right now it's not telling you that there's a substantial level of stress that something important is breaking yet. Am I getting the right
Correct.
message?
Correct. Um, and there's another way you can look, and I just noticed this, but my screen got cut off at the bottom. But what we have at the bottom is an analysis of LQD, which is the investment grade ETF, and junk, which is the high yield ETF. So, another way to look at it is to watch the prices of those two every day. And if we're getting into a more concerning scenario, JNK should be underperforming LQD. And that has been happening to some degree. So that's another way to keep an eye on the situation. And you can compare LQD to IEI, which is a treasury equivalent. And looking at those three, see how they're moving. And if you start to see J and K grossly underperforming LQD and LQD underperforming IEI, that's a sign that there's something going on, and you'll see it in these spreads as well.
Okay.
So,
So just as I asked you to kind of, prognosticate what might happen with bond yields from here, um, without the benefit of future data yet, how worried are you personally about the private equity risk to the markets, about private equity, as Lance and I have talked about many times, it's opaque, it's unregulated. What is your level of concern that we're going to find a lot more cockroaches as time goes on, to borrow Jamie Dimon's term?
so it's a little reminiscent of subprime. The question really is not how bad is the private credit market, and it wasn't really how bad is the subprime market. It's how much leverage and how much of that leverage was directly or indirectly on the major bank balance sheets. And I think that the answer is a decent amount less than the last time. So the impact to the true liquidity providers is hopefully a lot less. And whatever happens in private credit can happen without basically destroying the whole financial system. But if you can keep an eye on it by looking at like the stock price of Blue Owl and some of their competitors, but also keep an eye on the banks, the regional banks and the major banks, and see if they really start trading lower, because that will trigger risk in the corporate bond markets as well. So, again, let's just watch and see and look for signs. The key is to know, the key, I think, really in all of this that we've been talking about is to know what markets to look for and know exactly what you're looking at within all those markets.
Okay. All right. Well, look, I'll let you keep chopping your way here down to the stock stuff.
We'll
Okay,
get
this is
there.
perfect. I was literally just going to say, is somewhere in these charts, are you going to talk about the dollar? Here you go.
Here's the dollar. The dollar has been one of the beneficiaries of this recent incident in Iran. But you can see the dollar's been rising since kind of late January.
Hmm.
Like every other graph, Adam, we got a nice blue rectangle, right? It's been range bound since June of 2025. So how's the dollar going to break out? The dollar has been the weak dollar and the weak dollar narrative, because the dollar really hasn't been weak now for almost a year. The narrative about dollar debasement and dollar weakness has been what has partially driven gold and silver and foreign markets, emerging markets, developed markets. So, I think everyone, it's funny. All the financial headlines about Iran are kind of focused on oil. I don't see many on the dollar. The dollar may be more consequential to the economy, to the financial markets than oil. And I don't see a lot written about that. Um, our daily market commentary on Monday actually leads off with that and explains why. But bottom line is everyone in the world uses the dollar. And now all of a sudden, borrowing in dollars for all these foreign countries has become more expensive by 2 or 3%. It increases their borrowing costs. Um, all these financial assets that look good with the weaker dollar don't look as good to domestic U.S. investors because the
Hmm.
dollar's appreciating. Multinational corporations that are transacting globally tend to be impacted negatively by a stronger dollar. So again, it's another thing. How's it going to break out? Or are we just going to stay range bound here? Um, and you may not like this graph, but it shows the correlation, the recent correlation of gold, silver, and the dollar. Soon as the dollar, almost to the day, when the dollar started rallying, that's when gold and silver kind of struggled. Um, Not surprisingly, because you know the gold and silver trade as a function of the dollar. Um, so that's, you know, if you're in precious metals, that's something else to watch. The dollar, it's both the dollar appreciating the impact it has, but it also impacts that narrative of dollar debasement. How can a dollar be appreciating if it's being debased?
Hmm.
And we've talked ad nauseum about debasement, so we won't go there today, but it kind of flies in the face of the story that the market has been telling, which negatively impacts the precious metal sector.
Let me just repeat what I've done so far. Um, Looking forward from here, when you showed us the 9-month channel that the dollar's been trading within, it's beginning to approach the upward part of the channel. What do you think is more likely? A breakout to the upside or just the dollar reverses and starts heading down to the other lower part of the channel?
Some of this depends, you know, to be fair, this is where my cursor is right around here is where, about Iran started.
Yeah.
So some of this is Iran. Uh,
Meaning things quiet down there, we may lose some of that premium.
yeah. So you have to be careful not to extrapolate the last 5 days for the next 3 months. Um, I probably would have said that we stay range bound, but we do. One of the risks that we've pointed out for a while now is dollar appreciation. That means that the dollar gets out the north side of that rectangle.
Hmm.
So, I think my base case is that we trend towards the upper part of that triangle, my concern for financial markets in general is that we break higher. Um, what would cause that? It may just be a weaker global economy. Um, believe it or not, the Fed cutting rates could cause the dollar to appreciate. So, keep an eye on the dollar, not just if you're gold and silver investors, but all investors, because that has been the backbone also for foreign and developed and emerging markets, some other sectors, commodity sectors as well. And again, it has a big impact on corporate, foreign, multinational type corporate earnings.
Hmm.
Um, so now we're going to move on to the stock market. And this is I'm going to zoom in on this in the next graph, but this graph shows you kind of that topping curvature that's been going on that we've been getting concerned about.
All right, and
Once
Michael, it
again,
looks like the screenshot here is actually missing what this is. Is this the S&P?
I'm sorry, this is the S&P. You're right, it is cut off a little bit, but I'll explain everything here.
Okay.
So it's the S&P 500. One thing I know this is very crowded, and I partially have it crowded for a reason, but I'll get to that in a second. But when you look at the S&P 500, I'm going to skip ahead for 1 second. Here's the S&P 500 since late December, this box. Can you tell me where, if I just said somewhere, if we go back to January 1st and we're sitting down, I say somewhere over the next 3 months, there's going to be this thing in Iran, and I tell you what it's going to be. And by the way, here's a graph of the S&P 500 for the next 3 months. Tell me where the thing in Iran happened. I can't look at that graph and tell you where it happened. My gut would tell me, just looking at this, it happened in early February or mid-February. There's nothing here that tells me that there was an issue with Iran, right? I know it sounds crazy because the market seems to be so volatile, but it's really hasn't broken out of its behavior. Its behavior really hasn't changed over the last 2 or 3 months. We have lower highs. That's not good. We're kind of drifting lower. I get all that. But if you just look at the size of these daily candles, the color of them, is there anything here that tells you that if you didn't know any better, that something pretty big geopolitically was occurring?
Yeah, I guess if you can see the green candle there that drops below the trading range in the beginning of
Right.
March, maybe if that
Yep.
were a red candle, you could make that point, but the fact that it's green, I'm guessing, sort of kind of negates that.
I mean, yeah, yeah. And again, we're trading, again, the market, I'm going to go back. The market is starting to arc. That's not good. We see this resistance line that's downward sloping. That's not good. But there's nothing in this graph that tells me the last 5 days is that different. And
Right,
I,
that
I
the
think
market
that's worth,
totally changed. Yeah.
it's crazy because if I would have not looked at a graph all week and then looked at one today, it's not what I would have expected.
Hmm.
Um, so starting at the top, the MACD continues to be a, dare I say, irrelevant. It's just been drifting lower with the MACD and its signal just going back and forth, not really giving us any kind of signals whatsoever. Like here, we got a great signal. And when there's separation between the two lines, you get good signals. When it's doing this, you really get nothing. The RSI is at 40. It's starting to get a little oversold. Can certainly go lower, but it's just that too, just drifting lower. And this bottom line is what's called the average true range. And this is for the last 14 days. And it basically subtracts the high and the low from each day and gives you an average. So the high point of each day and the low point. And it's it's first of all it's low, but it hasn't really picked up. Again, back to my original point, it hasn't picked up appreciably, not like you typically see during volatile markets.
Hmm.
So, one takeaway is that I think what we think about the markets, myself included, is probably a little more volatility than what we see. Um, Now, when you dig into this graph, you can see one reason it looks so jumbled is because all these moving averages, the 20, 50, and 100-day moving averages are all right here. They're all next to each other. All the kind of support or resistance. When we are today, we're below the 100-day moving average. That is one of our lines in the sand. Um,
Can,
and
can you go to the next slide as you're talking about that,
yeah,
the
I think
close up?
this, yeah. So this gets a little easier.
Yeah.
You can
And
see the
just
20,
talk if you can about that. Yeah, the crossover of the 20 and the 50.
right. So we have a 20, 50-day crossover. That's not good, but it's a sh relatively short-term moving averages. So you have to be careful paying too much attention to that. And we got the 100-day, which we're trading below today. We'll see how we close. And we closed it below it 2 days ago, and we've dipped below it on a couple occasions. But that is a line in the sand. And then, we don't want to keep setting lower lows. So we have this low all the way down here at 6,700. That's another 100 plus points away. And then at the end of the day, what we have is the 200-day moving average sneaking into our picture at, close to 6,600. That's an important one. So, we're growing concerned. And that's one reason we reduced our exposure by about 6 or 7% over the last month because we've been seeing these patterns develop. Uh, and so when you say, okay, what's going to trigger us to reduce exposure? We got our close eye on the 100-day moving average, the black line. We're looking at these lows, which are not that much. They're another 40, 50 points where probably about where we're trading now. We're right around this line. Um, the 20-day is probably going to go through the 100-day moving average. The 50 is not going to go through the 100 anytime soon. And we got the 200-day moving averages. So those are some of our lines in the sand. Uh, Conversely, if we get some good news, if the price of oil drops $10 this afternoon or next week, we'd like to see get above these moving averages, break out this downward trend, and then ultimately start hitting higher highs. Um, so that's kind of our roadmap for the,
All right.
I guess, week, 2 weeks, few weeks ahead.
So, Michael, I know you're kind of reacting to what you see in real time here, but like in your conversations with Lance, is there anything right now that's on your short-term roadmap that if this happens, we will lighten up? Like, for example, if there are 3 days that now close below the 100 daily moving average, would that make you guys say, okay, we want to reduce a little bit of exposure here?
Yeah, possibly. Possibly. The tougher question for us is how do we do it? So there's been a distinct, and we'll get into this in a little bit, a distinct uh, difference between, a massive rotation, which, we've talked about. I know you and Lance have talked about it, between growth and value, between large cap and small cap. So one of the things we've been finding is, again, that there are days where half our portfolio, the stocks are up, half the stocks are up 1% or more, and at the same time, half of them are down 1% or more. So, and those stocks, it's not always the same stocks. So what do you sell? That, you want to keep this diversification, but you want to reduce your exposure. So we could sell growth and value. We probably would sell more value. We've been selling value on the margin. We may want to sell more value because it's grossly overdone here.
I was going to ask
Or-
about that. Yeah, exactly. Because
And,
value,
and,
Lance has
and
been
we'll
saying
get
some of
into
these
that.
value stocks you can't really call value anymore, right? Given their PEs.
You're leading me right along the way.
Oh, good.
Or we could just add a short position. We could buy the SHETF and just say, you know what? We kind of like the portfolio, but let's just add a little insurance.
Hmm.
So we could do it any number of ways. Um, so, back up here and here, I kind of was stressing to you that the market is relatively calm. If you didn't know what was going on behind the market, you'd say the market, and I actually wrote an article about this a week or two ago, the the not the implied volatility in the options market, but the actual realized volatility has been very low. But beneath that calm, serene surface, there has been some incredible volatility in rotations, moving back and forth between different sectors, different factors. So what I have here is what this does. This is from SimpleVisor. It looks back at the excess performance. So, for instance, how did energy do versus the S&P over the last 75 days? And then it goes back in 75-day increments before that. How was it the 75 days before that and the 75 days before that 75-day period? So just look at some of these differences here. So I got to move my computer a little, but energy, and I'm going to actually leave off energy because some of that is impacted by Iran, but
Yeah.
materials up and transports up 70%, while financials and technology down 4 or 5% versus the market. Those are big differences. Industrials, consumer staples up 12%. And then you go back to the 75 days before that. Look at some of these. Look, staples were down 12%. Healthcare and technology were up versus the market. So we've had, there's a fancy way of saying we've had a big rotation. Flipping over to our new simple visor, I'm looking at year to date. This is a grid I look at every day. It tells me I look at it usually on a 1 day basis. So what's the market doing today? But year to date, growth stocks are down a large cap growth is down 3.59%. Value is up 5.65%. All the small mid cap, even growth and value, are all up on the year. So, you can kind of look at this in a nutshell and see what's going on. And it's basically that the mega cap stocks, the Magnificent Seven, that were the greatest things ever, are falling out of favor, right? And people are buying value. And we'll talk about that in a second. What's value and what's not value. Well, where am I? And then I just also want to show you down here. So again, I'm year to date, and you can see how some of the sectors have been, the divergences in performance has been crazy. And this is why our diversification in our portfolio really helps, is because we have things going down, we have things going up. But it's allowed us to beat our benchmark, beat the market for the year by slowly shifting between what's working and what's not working. So with that, can we talk about what's value and what's not value, Adam?
Sure. Yeah.
Okay, so here's what's funny. And let's just use Nvidia and Walmart, right? It's no secret the market's been selling the Nvidias of the world and buying the Walmarts of the world for the last 3 or 4 months, right? And in doing that, what they'll tell you is they're selling growth and they're buying value. But what is value? So this is from FinViz, great graph. It's a heat map of the price to earnings ratios of the S&P 500 companies. The bigger the box, the bigger the market cap. So it's market cap sized, I guess you would say. The brighter the red, the higher the price to earnings. Green is more value oriented. So, and they're all sorted by their sectors, technology. And so we're going to focus on technology and defensive. This is consumer staples and technology. Um, so the first thing that you see, and this is what Lance and I started the year off with our concerns, that valuations are too high. And it's not just the NVIDIAs and the Googles of the world. It's everything just about. There's a little spots of green here, but you can see there's red in staples and utilities, real estate, energy, healthcare, pretty much financials across the board. But look at the price to earnings of Walmart. It's 44. Costco's at 52, right? So they're selling Nvidia at 37. They're selling Microsoft at 25, Google at 27, Amazon at 30, Meta at 28. To buy companies that are not necessarily growing that fast, at 44 for Walmart, 52 for Costco, Pepsi at 27, Coke at 25, McDonald's at 27.
Right. These are your classic cash cows, the companies that don't grow that fast, but they
that
just,
don't grow. They have
yeah.
earnings that are very tied to economic growth, that are somewhat very, decently predictable. The problem with looking at price to earnings is you're looking at last year. If I'm buying a company, if I'm buying a business, what I want to know is, I do want to know how it did last year, but I want to know is how's it going to do next year? Because that's what I'm buying. I'm buying the future. I'm not buying the past. So we can look at it two different ways. Instead of looking at backwards price to earnings, trailing 12 months, let's look at earnings for expected for the next 12 months. And just for context, the S&P 500 is around 21, 22. All of a sudden, Nvidia is cheap, cheaper than the market at 17. Google's at around the market level 22. Meta's cheap to the market. Microsoft is about at the market. Look at Walmart at 37. Costco, double the market. Um, these names, Coke, Procter Gamble at the market. Starbucks at 33. Um, so all of a sudden you're starting to see that they're buying what they think is value at very high valuations and shedding growth companies that are also starting to look like value companies. But now let's take this one step further. This is really important here. So now instead of using forward earning 1 year forward, we're looking at expected growth rates over the next 3 to 5 years. Now, I'll be the first to tell you that no one knows what's happening in 3 to 5 years, especially with the pace of AI. But these are based on estimates. So it's not as, look, we know the trailing earnings are what they are. That's happened. It's already happened. Forward 1 year is decently predictable. It can be off, but we have more insight into the next year. This extends it a little further. And what it does is it takes the forward PE and divides it by the growth rate. So how much, it basically sizes PE to to show you with the growth. Um, it's a
And Michael,
very
just to give, say it for folks. This is the price to earnings growth ratio, or what's called the PEG ratio, correct?
correct,
Okay.
correct. Basically factoring in growth into the equation because growth is what you're buying.
Yeah.
All of a sudden, so usually a PEG ratio 1 is considered the borderline between cheap and you start getting expensive above 2, but below 1 is cheap. And look what we got. Nvidia at 0.44, Microsoft at 1, Oracle, the beaten down stock is around 1, Broadcom at half, Amazon around 1, Meta around 1. Um, and what do we have up here? Walmart at 3, Costco at 4, Coke at 3, Procter Gamble at almost 5. Look at the utilities. They're not much better. Um, so you could say, okay, but NVIDIA's, I think the growth rate incorporated into NVIDIA is something around 50%. They're not growing 50%, you may say. That's fine. What if they only grow 25%, which is well below the 60% growth rate they just reported? It still has a PEG ratio below 1.
Hmm.
Then we got Walmart that whose earnings could not be more steadier around 7, 8, 9% at a PEG ratio of 3. So what's kind of really funny to me is that this whole value rotation is a rotation from value into very expensive stocks. And no one knows it because they're in this world now where we just look at ETF names and assume that because it's the value ETF, it holds value stocks.
Right.
And it's it's kind of become a farce. Because we're not as investors looking at individual names and looking at fundamentals. You're buying titles now. And because Nvidia's in the growth ETFs, it can't be value. It certainly is value at this point. And if you want to buy value, look at Nvidia is right up there. It's you don't see looking at this table, how many other companies do you see with a PEG ratio below 44, or even backing up with a price to forward earnings below 17? So, um, this kind of goes back to the market. I know it doesn't feel like it, but it's been calm. But underneath, you've had these massive rotations that have really distorted the market. And with that comes opportunity.
Hmm.
And that's why we have been shifting from quote unquote value to growth on the margin because we think that relationship, not think, we have technical gauges that tell us that relationship is overdone and we're due for a shift to growth stocks,
Yeah.
the
Okay. So
stocks that
it seems.
fall into the growth stocks category. Now, what we don't know is the shift going to last? First of all, we don't know necessarily if the shift will occur just because we think it does. But if it occurs, is this like a 3 or 4 week event where growth is back in favor and we hear about the Magnificent Seven, and then value is kind of the predominant winner throughout the year? Could be. But right now, we're seeing signs that we're shifting back towards growth away from value. Um, and you've seen that the last couple of days, some of those names, Walmart got hit pretty hard. And even though it's a conservative stock to hold, it's just grossly overvalued at this point.
Okay. So potentially the market has been throwing the baby out with the bathwater when it comes to the growth stocks, right? You've had the hyperscalers hit over the past couple of months as capital has left them and gone into value. Definitely a lot of software stocks getting just clobbered like they're almost going out of business.
Mhm.
Um, so Michael, you're saying, okay, wouldn't surprise you. In fact, you're doing some positioning already for capital to start going back to the growth way, and your charts certainly make a compelling case. I want to ask you a question I've asked Lance in the past, which was when you guys were talking about rotation happening this year, I asked, could the markets, the general markets, the S&P, could that materially rise driven by the value sector versus the growth sector? Um, and I expressed some skepticism for that because the market weight of the growth sector is so huge, right? And Lance was like, "Yeah, I don't think the value sector alone can pull the S&P continuously higher." And maybe that's why things have been so range bound for so long, is as capital has been flowing into it's been flowing out of the big guys into the little guys, and I'm painting with a broad brush here. The markets just kind of stayed more or less the same. If you see a material rotation back into growth, does that make you begin to expect that the S&P may break out above the current range that it's been in, simply because an increase in those larger cap companies will have a much more disproportionate effect on the S&P?
Yeah, I mean it's just math,
Yeah,
right? It's really just a math equation. If if the stocks contributing the most to the S&P 500 go up, that should be good for the S&P 500. If the stocks that don't contribute nearly as much to the S&P 500 go up, but the biggest stocks go down, it's hard to expect the market to go materially higher. Now, over time, what happens is as the value stocks go up and growth goes down, those size of those boxes I was just showing start to shrink, and the size of the Walmarts and Costco's start to get bigger. So over time, I think it can start to have more of an impact. But I think it's going to be really hard for the market to rally without the magnificent, it's not even seven, it's really top 10 or 15 stocks. Um, and so that's why if we do get a rotation of growth, could be positive. Now, if growth and value start selling off in unison, which we have seen a little bit of that from time to time, then you could get the whole market coming down.
right.
But the other thing though is value has also supported the market while growth has gotten hit pretty hard, right? If you look at the returns on some of these tech stocks, they're down decently. And if I would have told people a year ago that the Microsofts, Google would be down, 10 to 20%, You'd say, oh, the market must have fallen 10, 20, 30%. That's not the case because the value was able to offset it. So, 450 stocks offset 50. Um, but, you really just have to think about it as a mathematical equation. And it's almost impossible for those 7 to 10 to 15 stocks to rally and the market really decline, and vice versa. If those 7 to 10 stocks are really doing poorly, I don't care what the rest are doing, it's going to be hard for it to have any kind of significant rally. But the
Hmm.
key is to move in and out, to figure out what's going to underperform and outperform.
Okay, so you've given some hints that you've been doing some trades on the margin. We're going to get to your trades in just a minute. Um, I just want to spend a tiny bit of time talking about the payroll data. So we got the latest payroll data this morning. It was kind of a shocker. I mean, it was the first real big downward shocker I think we've had in a while. Um, I think it was a Six Sigma miss to the downside. So it was minus 92,000 jobs um, for the past month. And the unemployment rate actually it was enough for the unemployment rate to tick up from 4.3 to 4.4%. Um, how material is this? Because, we've been skeptical of just the jobs data for a long time. I mean, for years. But even of late, uh, the job market just seems from a whole bunch of other metrics to be soft, right? We've sort of been trapped in this no hire, no fire economy. But you look at things like initial claims and stuff like that, you don't see, they look fine. You don't see signs of real distress in the jobs market here. This is maybe the first real data point in a while where people are like, okay, whoa, wait a minute, maybe there is some real trouble here. That said, we had, Snowmageddon in February where a lot of people couldn't go to work. So how much of this is something we should be worried about versus just the effect of extraneous things like, the week or two of
So,
folks not being able to get to work?
so I certainly pay a lot of attention to the BLS report, but I've been over the last few years focused more on ADP. It's just using real data.
Right.
It,
Yep.
it, it and it's been telling us the truth. The economy's growing, jobs at 30, 40,000 a month. That's that's what's been going on. It's muddling along. It's not good because the economy or the population growth in the working age is about 150,000 people. So there's an issue. We're only adding 30 to 50,000 jobs against a growing workforce.
Right.
That said, I hate the BLS December, January, February data. The seasonals are so extreme that it gets, and then you get the weather impacts, like you said, that you get remember the number last month was probably a, what, 3 or 4 sigma to the upside. Um, so you just get this volatility. But if you look at the two, they net out to be about 15,000 positive jobs a month. And I think that's kind of in the ballpark of what the economy is doing.
Okay. So
Not not
you're
good.
not too triggered or worried by this particular payrolls report. Obviously, you've got some concerns about just sort of the anemic job growth that we have in general, looking at ADP and other sources.
It kind of looks like that S&P 500 graph. It's arcing in the wrong direction, but it's not, there's
Right.
nothing there to tell you that the unemployment rate's going to 6% or we're going to start losing jobs every month. Um, but the hardest part with this is that personal consumption's at 2/3 of the economy. And when people feel um, unconfident about their job prospects or they see their neighbors get fired or their colleagues lose their job or they don't get a raise or a bonus, they spend less. So the question will be is, does this anemic job market, not bad, not good, feed into the consumer psyche?
Mhm.
And that's what we keep waiting to see. Retail sales today were minus 0.2%. They were 0% the month before. That's a bigger deal that no one's focusing on. And those are not real, those are not adjusted for inflation. So if you say inflation's running at, pick a number, 3%, that means retail sales are declining on a real basis.
It's just,
So
let me ask you a question I just asked David Rosenberg in the video that launched before this one. Um, we've got this K-shaped economy. The top leg of the K, the affluent folks, they punch way above their weight when it comes to spending. Something like the top 10% is responsible for 50% of consumer spending. And we've seen lots of reports over the past couple of years that the bottom leg of the K, which is the majority of people, is increasingly struggling. And the question I asked him was, I mean, I hate to ask it this way, but is the bottom leg of the K, is it kind of immaterial what happens to it as long as the top leg of the K continues its spending? And David pretty much said, yeah, sadly, I think that's the case. What really matters here is the spending of that top leg. And what really matters to them is the wealth effect of asset prices continuing to go up, i.e., the market. Meaning, if the market actually weakens, or in his case says even if it just goes flat for long enough, that's going to be the biggest thing to impact the economy because that top leg will then start to restrain its spending, and that's going to be really observable. Do you,
this is the S&P question you just asked me.
yeah,
What are the top 10 stocks doing versus the other 490?
right.
And it's the same answer. Uh, and what's interesting is there's always this old saying on Wall Street that the stock market predicts the economy, and it always peaks 6 to 9 months before GDP starts falling and you go into a recession, right? Well, maybe it's not that it's has such great foresight because we know it doesn't. It's that it's the wealth effect, right? Bernanke told us this. When he launched QE1, he said he's trying to help the financial markets, which improve spending ability for those people that own stocks. And he called it the wealth effect, the trickle down theory, the virtuous cycle, right? Everything's wonderful as stock prices go up. And I think David's right. If the stock market continues to tread sideways, doesn't even really have to go down. You're slowly starting on the margin, taking away the spending of those top 10, 20%, 15%, whatever it is. And at the same time, we know that the bottom 70, 80, whatever that is already struggling, right? Savings rates are really low. They're using a lot of credit cards. So there's not much room for them to expand other than wage growth, which has slowed down materially.
Mhm.
So, yeah, I think largely that this could be another instance where no one sees a recession, but the stock market stays flatline, stays in its rectangular box or starts heading lower, and that impacts the behavior of the top leg of the K.
Yeah, this goes to sort of like, you know, don't get too fixated on what you think the markets in the world should do. Just be fixated on what is. You'll have much better success. Like I hate the tenor of this conversation because it basically says it's rich people's world and the rest of us just live in it. But as an investor,
Oh,
what it's telling me is don't stress as much about the jobs data as perhaps even I have in the past, because it may not matter as much as it applies to the majority of Americans. What does matter more is where is the stock market going, because that's going to then impact the big numbers that impact us all in the long run.
yeah, but there are some big social impacts, and we could very easily see that in November with the election.
Sure. Well,
If the
again, that's what I said to David is it may be immaterial until it crosses some extreme threshold where the pitchforks and torches come out, and that's when
Right.
things change, either at the voting booth or hopefully never in the streets. Yeah.
Right. I mean, we're going to see the word affordability is going to be the Democrats' rallying cry for the next, what do we got, 7, 8 months? You're going
Right.
to hear that word more and more. And it's exactly, they're addressing that bottom leg of the K,
Yeah.
the 70, 80% that can't afford stuff. And now the price of gas is higher. So
Right. Well, the
it,
irony is,
it
is that affordability was the rallying cry of the Republicans in the last election.
of course, yeah.
Yeah. All right. So in wrapping up here, Michael, trades. What trades have you guys made over the past week?
So we shifted the portfolio a little bit more from value to growth. And actually, I don't know if Lance talked about it, but it was either last Friday or Monday. I think it was last Friday. We true upped NVIDIA. So all accounts that are new and they weren't fully allocated, or accounts that had added cash, we bought NVIDIA up to the model weight. So it impacted maybe half of our clients to some degree or another.
Hmm.
We continued on that theme this week. We bought Salesforce and ServiceNow, CRM and Now. We added
Yeah.
1% of each. They're both
I-
software stocks.
right. Okay. And I think Lance mentioned those because I think he did them last Friday. That was entry positions, correct?
Well, we just did it this week.
Oh,
Uh,
okay.
we
Maybe you
did
said you were
it.
going. Maybe you said you were going
We
to.
were
But then,
thinking about it.
okay. But
Right.
those are entry positions, right? You're adding them.
1% each. We're dipping our
Okay.
toe in the water. We'd like to increase them, but you're still in a period where you're catching a falling knife, and that narrative is pretty damning. We don't necessarily believe it, but again, that's what's driving the price. To make room again, because we didn't want to increase our exposure, we want to keep it where it's at. If not, we actually decreased it very slightly. We sold Altria, we sold Visa um, outright. We also actually brought Microsoft up to model, which, because it had done poorly, meant that we added almost 1% of Microsoft to most accounts. So again, we shifted towards growth, towards technology, and away from perceived value.
Okay. And totally makes sense given everything you walked us through in
And
your slides.
and Altria is pretty interesting. That stock, we were forgetting the dividends, and they pay a hefty dividend. We bought it a few months ago. We were up 20% on that. That of all the stocks, that's a cash cow. That's just there is very little growth in that company, and it just spits out cash. So
Hmm.
that tells you how extreme this value trade has been. We bought that in Verizon the same day. They're both up roughly 20%.
Wow.
So they're really pushing stocks pretty far that don't really have that much growth
Hmm.
potential. Altria has very little, Verizon has more. But so that's, that phase of our rotation where we went to value, we're starting to peel back out of.
Yeah.
That's kind of
And
what
this
you're
is where
seeing.
your decades of expertise really come into play, where you can get to a point where you're like, look, we hope to trade like this, the trade would perform like this, but we know just historically it's gotten
Mhm.
ahead of its skis, time to lighten up.
Right. And when I'm looking at our list of trades here, the last 2 weeks, 3 weeks before, they're all sells. They're all small sells, but they're all profit taking in almost in all cases, value sector. Duke Energy, JP Morgan, Kinder Morgan, Altria, Verizon, Walmart, Berkshire, BlackRock. So, we're just slowly shifting, moving with those, not with we haven't really had to move with what's on the surface, but with what's underneath the surface. And back to what you were asking me, when are we going to move to reflect what's on the surface? And that's when the whole market, if it starts breaking down or breaking up, whatever may happen.
Okay. All right. Well, look, I want to end with just a very short rant here, and this is a positive one this week. Um, so, kind of thinking it in my mind as helping the helpers. So, we had the outbreak of the war in Iran, and I read something on X, and I'm going to do this from memory, but it was basically somebody, talking about the stresses that we all feel when a nation goes to war. And they were reflecting on something their grandmother had told them when they were young in life, which is, um, don't just be full of fear about the bad things that are happening. The grandmother said, "Hey, when something bad happens, what I like to do is I like to look at all of the people that rush to help." And that makes me feel better about kind of the human condition here. It gives me faith for the future. If something bad happens, you get a lot of Samaritans and altruists. You get out there and try to, basically help improve things. And my really the credit goes to my wife. But my wife and I did something this week that felt great. And it's sort of a helping the helpers type of thing, which is, we've moved to Reno last year. We're still discovering the city, and my wife found out about this organization called Liberty Dogs, which basically raises and trains dogs and then gives them to veterans who are returning from combat. And these, they're all labs, great personality, and they're very well trained, both in terms of normal commands, but also things that are sort of specific to the chronic issues that a lot of veterans have to deal with, the PTSD, the anxiety, the night terrors, that type of stuff. So anyways, you can sign up to be a foster family for one of these labs, puppies, and you basically raise it. And you raise it for like a year and a half. And then it goes off. Once it's all trained up, it gets paired with a veteran. They bring the veteran out for a couple of weeks. They get to meet the dog, learn all the commands and everything, and then they go home with the dog. It's a wonderful organization. And we've got two dogs of our own. We're not ready to sign up for a 18-month commitment or anything like that. And honestly, I don't know if I ever could do it, because it's personal failure, I'm sure, but I don't know if I could raise a puppy and then give it up. It'd be like giving up your child, right? But what my wife signed us up for was this kind of helper list. So the families that are fostering the puppies, they have life needs. They got to go out of town for a wedding or whatever, right? And so you can get yourself on a list to help them out and take their puppy while they're gone, right? So we had this wonderful little puppy for the past 3 days. So super fun. Nothing but joy for us, and we've got two older labs, and they learned to love her, and everybody had a great time playing together. But just karmically, just felt so good knowing that we were helping such a worthy organization, helping such worthy people. So, anyways, I just wanted to share that. I encourage everybody watching this to sort of think for a moment about like, well, what could I be doing at some point over the next day, week, month, whatever, to try to help some of the helpers in my community. Just coming fresh off it, I'm feeling that karmic high, and really would love to see that spread to more people. So anyways, I'll end the rant there unless you have anything you'd like to add to it, Michael.
Nope. Nope. That's really nice, Adam. I would take a puppy for a few days, but unless I'm gonna keep it, that's it. A few days
Yeah.
is enough.
Yeah, a few days is enough. And it is funny too, because like, every so often I get wistful and like, oh, we should get another puppy at some point. It does remind you, it is kind of like having a toddler. It is a lot of work. But the fun aspects way outweigh with the work stuff. So, all right, well, we'll wrap it up there. Folks, if you think one of the best ways to help the helper and yourself is to continue to watch and listen to Michael and his partner in crime, Lance Roberts, there on this channel every week to help guide your investment decisions. Let Michael know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like to get some help from a professional advisor in either maybe transitioning your portfolio a little bit more from value back to growth, given what Michael has told us about here, or just protecting against some of the risks that he's talked about here, highly recommend you get that counsel from a good professional financial advisor, and importantly, one that takes into account all the macro and market issues that Michael has been talking about here for us. If you've got to go and who's doing that for you, great. Stick with them. Don't mess with success. But if you don't, or you like a second opinion from one who meets those criteria, consider scheduling a consultation with one of the financial advisory firms that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd like to talk to Michael himself and Lance there at RAA. So to set up one of those free consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. As mentioned, these are totally free. There's no commitments involved. It's just a service these firms offer to be as helpful as possible. Lastly, if you're watching this when this video launches, which would be Saturday morning, you now have less than 48 hours, if you haven't already, to buy your ticket for the Thoughtful Money Spring Online Conference at the lowest early bird price discount that we've been offering. I want as many people who go to the conference to get this lowest price as possible. So literally, folks, right now, pause this video and run, don't walk to thoughtfulmoney.com/conference and buy your ticket there, lock in that low price. If you are a premium subscriber to our Substack, check your email box. You've gotten a code from me that you can use to get an additional $50 off of that low early bird price that I mentioned. The conference itself is going to be Saturday, March 21st. Don't worry if you can't actually watch the event live that day, because everybody who buys a ticket will be sent replay videos of the full event, all the presentations, all the live Q&A, and you'll be sent that within hours of the conference's conclusion. Michael, I'm just going to rattle through it real quickly, but this is an unbelievable faculty, probably the best we've ever had, and it probably may be the most timely one of these we've ever done, given everything that's going on, not just in the markets, but obviously in the wider world, Iran being the prime example of that. But the conference will be kicked off by Lacey Hunt, and he'll be doing his usual graduate level keynote that he does for every one of our conference. We'll have first timers Ed Dowd, Michael Oliver, and journalist Matt Taibbi. We'll have Luke Roman and Brent Johnson. We'll have Judy Shelton. We'll have Daniel DiMartino Booth. We'll have Michael Howe. We'll have Darius Dale. We'll have Stephanie Pomboy. We'll have Lance Roberts. We'll have Lynn Alden. We'll have Rick Rule. We'll have Darius Dale. We'll have Melody Wright. We'll have Andy Scheckman. Man, I think there's one or two others I'm forgetting, but it's a massive murderer's row. It's going to be really our best conference ever, folks. So again, if you haven't bought your ticket yet, go to thoughtfulmoney.com/conference. And with all that being said, Michael, as I say every time you're on, we should have you on more often. That Lance guy should go on vacation more often. It's always wonderful to have you on here, to have the brain trust of the RIA organization here to talk to us. So thanks so much, and I'll give you the last parting words if you've got any counsel for folks watching here.
No, just first of all, thank you for your kind words. And look, we're in volatile times, and this is when it's most important to have your rules and not let your gut get the best of you. So, or the voice in your head. The voice in your head's even worse than your gut. So, I know it can be scary what's going on, but just because it's scary doesn't mean the market's going to fall 30%. But, you just follow your rules. And if you do that, you will get out of the market when you need to get out of the market. You'll stay in the market when you think you should get out of the market. That's it. That's all I got.
All right. Well, very wise words. All right, my friend. Thanks so much. Great having you on this week. Hope we have you back on again soon. And everybody else, thanks so much for watching.
Bye-bye.
Obviously, I could adjust my silver up, a bit. I mean, it wouldn't surprise me to see 40, 42, who knows, maybe 50, right? I mean, and I didn't say silver wouldn't, I said just basically don't bet on it. I think silver is bullish at the moment. Gold at the moment, I mean, today, price of gold's down 2%. Will it be up 2% tomorrow? I don't know, maybe. But, we're in a bull market, a long-term bull market for all these reasons, and probably both metals. I'm just less excited about silver, for these reasons. But yeah, I think in both metals. And, for the rest of the year, would it surprise me if we fell short of 3,600 in gold? No, it wouldn't. Would it surprise me if we surpassed 3,600 and we resume the march up and we see 3,800, 3,900? No, it wouldn't surprise me either.
Silver might fall behind gold's momentous rise, but that may leave more room to run when the gray metals rally takes off. With renewed retail interest, sustained industrial demand, and another supply deficit, silver enthusiasts expect prices to reach $40, which aligns with the average expert price forecast for 2025. His benchmark rises to $50 when looking to 2026. Gold regained momentum after losing ground in the days following the announcement of tariffs on April 2, as investors sought safe haven assets. According to the bank's economists, there's a 45% chance of a U.S. recession within the next 12 months. If that happens, the analysts said gold could hit $3,880, $3,800 to $3,900, by the end of the year. Keith Weiner, a U.S. economist and founder CEO of Monetary Metals, points out that a recent U.S. customs ruling, suggesting tariffs on 1 kilogram and 100-ounce gold bars, briefly sent gold futures to record highs, disrupting global bullion flows and threatening New York's role as a key price hub. Markets yanked back once the administration clarified that gold would remain tariff-exempt. Weakening global currencies, excessive government debt, and its status as a non-sovereign financial asset continue fueling its safe haven appeal. Analysts expect continued strength, despite temporary pullbacks. Volatility amid tariff uncertainty would be beneficial for gold. Central bank purchases of gold also continue to rise amid a de-dollarization push driven by the administration's tariff policy. Investors have been riding the gold gravy train all year, according to the latest gold demand trends report from the World Gold Council. Gold ETF inflows reached 170 metric tons in the second quarter of 2025, valued at nearly $400 billion, marking the strongest first-half finish since 2020. Silver prices have dropped to their lowest in over 8 weeks. Unlike gold, which thrives as a haven, silver has yet to follow suit with similar gains. Markets increasingly view silver through the lens of industrial performance, especially vulnerable given sluggish factory data and new tariffs, casting a shadow over its near-term outlook. Before we begin, please click the bell icon and subscribe to stay up to date on our latest uploads. We always value your thoughts and feedback.
Yeah, so this is one of those things where, unfortunately, there's a lot of bad takes out there in the gold community. And these bad takes all have the same recipe, which is something happened, and therefore, because something, that's going to cause the price to go up. It always leads to the price to go up. Good news, the price is going to go up. Bad news, the price is going to go up. No news, the price is going to go up. And so we thought that, when Trump took office, there was going to be tariffs on a lot of things, and there was a fear that that was going to include, gold and silver, which would have been really bad. I mean, it would destroy the futures market in the U.S. and force it to go somewhere else. And then we got clarity. No, it doesn't apply to the precious metals. Okay. And it doesn't apply to copper and some other things. Okay, great. Then, I don't remember when that was. Seems like it was a couple of months ago. It does apply to copper after all. So that's really going to kill everybody who manufactures with copper in the U.S. And create some perverse incentives. So, cars don't use that. I'm trying to think of what really uses a lot of copper, but it'll make sense to manufacture that in a low tariff country and import it as a finished good rather than importing the copper and manufacturing it in the U.S. So some very perverse incentives there. But we got on Thursday, it came out that some big trader or refiner had asked, I think it was the U.S. Customs Agency for a ruling letter to clarify the status of gold. They wanted legal clarity so that they're not risking not paying something they're supposed to pay. And, obviously they want to make their plans and their investments. Nobody wants to invest money only to be told by the government later, actually, your investment is rendered useless because of this tariff. And the letter came back and said that kilo bars and 100-ounce bars are tariffable. They're in the category that's subject to tariffs. Well, that sent the gold market into a tizzy, because apparently that takes effect immediately. Let me talk about kind of the difference of silver versus gold. Silver is much more the working person's precious metal. And when you start to see the jobs market, which wasn't really all that strong for, blue collar, trades. Yes, certain trades at certain times, if you're in the building trades in certain booming cities, I'm sure there was unlimited work. There was a period of I'll call it the unlock whiplash after COVID lockdown was over, where, truckers, had all the work they could handle and more. But overall, the market for, people that are working with their hands or doing a skilled trade, just not been that strong a market. Now, certain niches within white collar knowledge workers like AI, scientists right now are getting these like $100 million packages. It's almost like reading about sports stars, you read about Michael Jordan getting a package like that, and now it's like these AI guys are getting it. But silver is the savings of tradespeople and blue collar workers. And now we're seeing the job market roll over, and that's going to hit, that segment, hard. And in addition, silver has this industrial component. And if manufacturing and all those other things are rolling over because of tariffs, for example, and also because this boom is just really long in the tooth. We're basically in one long boom that was juiced up when in spring, or was it March, April of 2009, the Financial Accounting Standards Board said, you don't have to mark to market the losses. And so the banks were able to restate their financial statements, and suddenly they looked a lot better. And that was pretty much the day that the market turned around and began to boom again. So we're in this hell of a long time, 16 years and counting of boom, which is very long by any historical standards. I think we're well into record territory. So that we could be rolling over just because of that. Tariffs aren't going to help, all kinds of other things. And so silver, because of manufacturing demand falling off a bit, and because of working people savers just having less to save, I would generally expect silver to underperform. Now, could silver outperform in the short term? I think there's a lot of forces building up to suggest it could, because the asset speculative class is seeing silver now. So if they jump into it, almost anything's possible in the short term. But gold, yes, because all the currencies, remain in this horrible bear market, and every government around the world has gone all in on madness, and it's getting madder, right? So we elected Trump as a protest against the profligate, stupid spending of the Democrats. And what do we get? A big, beautiful spending bill that accelerates spending even more. And of course, gold responds to that because it's just, it's just a hedge against being a creditor to the government, which is what, if you hold the dollar, you're effectively a creditor to the government. And when the government's becoming something that embarrasses even drunken sailors, you don't want to be a creditor. Well, look around. What asset can you buy that's a financial asset that isn't being a creditor to the government? It's gold. So yeah, we're in this gold bull market. Silver, I think, medium to long term, not really. Maybe it'll keep up with gold at this point. It's not going to outperform. Short term, yes, there could be a big pop in it. That wouldn't surprise me, given everyone can see the chart patterns and say, wow, silver's going to pop. And then they'll make it pop, right? But, is the real long term demand there for it?
Silver's resilience is evident compared to previous years. Since the start of 2024, silver has gained over 50%, demonstrating increasing appeal for investors seeking diversification and growth potential in precious metals. Renewable energy, particularly solar power, continues to fuel demand. Despite some uncertainties for U.S. renewable projects under the current administration, global solar installations are expected to hit new records in 2025, all good news for silver. The solar sector's appetite is so large that by 2050, it could consume nearly all of today's known silver reserves. Geopolitical tensions add complexity. Russia and Mexico, two of the top silver producers, face ongoing political and regulatory challenges that could further restrict supply. Silver's reputation as a safe haven is growing amid economic uncertainty. Volatility stemming from tariff threats and policy shifts since early 2025 has prompted investors to seek tangible assets, such as silver. Interest rate expectations also matter. Even if rate cuts slow, sticky inflation suggests real rates could fall. Silver is set to hit $40 this year and $50 by 2026, according to Peter Croft. The silver stock investor author credits the simultaneous rise in industrial and investment demand, ongoing supply deficits, and positive market metrics for this bold price forecast. Under the right conditions, Croft even thinks silver could explode to $300. Even famed silver investor Eric Sprott shares a similarly ambitious expectation of $250 to $500 silver. Let's redirect our attention towards the interview.
there's a point at which there isn't even necessarily an explanation. Now, the silver people will talk about structural deficits. Now, they've been talking about structural deficits since before I got into this. I sold my company in August of 2008. So I guess we're exactly 1 week away, a week and a day away from the 17th anniversary of that sale, right? That was August 19, 2008. And when I started reading about this stuff in fall of 2008, they were talking about structural deficits for silver. Now, if the price moves, especially sharply in a short period of time, you can't look to a 20-year-old story as the explanation. It's like the left says, "Oh, consumer prices went up this month because of greed." Wait, are you saying there wasn't any greed last month, and this month greed came into the market, and that's why prices went up? Like, if there's something that's basically a constant, greed is a constant, and the alleged structural deficit in silver is a constant as well. It doesn't explain change to the margin. So a lot of people may cite that, but at some point sentiment, takes over, and then everybody, wants to buy. Yes, it's true in places like India, if gold is perceived to be too expensive, it's also out of reach for, very large numbers of Indians just don't have. A minimum wage in India is between $2 and $5 a day. So it doesn't afford them, much if any gold. Silver is much more affordable. So, if gold becomes less affordable, there'll be some switch to silver at the margin there. That's true. And that can drive it a little bit. Silver is a smaller market. But at the end of the day, I think it's sentiment. The sentiment can be self-fulfilling for some period of time. As it was, I think there was non-sentiment factors as well in 2011, but look at what happened to silver in the first part of 2011, right? We shot up in late 2010, silver was under $20. And by, was it March? It hit peak or April in 2011, it was $50. So boom, 2.5 times. And then we spent how many years in a bear market in a silver wilderness? So the sentiment, when it turned. It was done. And that first day that silver dropped from $49 to 30, was it 35 or 34? It's like within a day. And all the smart people were like, silver's done, stick a fork in it. It's not going to recover the $50. This is not a market correction. This is wicked volatility. This is a bear market. If you have a loss, take your loss and move on. If you still have a gain, lock it in and move on. This thing is done. And it was for a long, long time. We still haven't recovered. 17 years later, we're getting closer to recovering. Could it go to 50 and beyond? It could. Will we see 30 on the gold silver ratio again? No way. To see 30 on the gold silver ratio, we'd have to see over $100 in silver. Keith Weiner, August 11, 2025. You're not seeing $100 on silver anytime soon. Not going to happen. It is what it is.
Although industrial headwinds and uncertainty surrounding tariffs may cause silver to lag behind gold in the near term, its long-term fundamentals remain solid. With projections of $40 in 2025 and $50 in 2026, silver is poised for substantial gains due to its continued industrial application, particularly in solar energy, as well as rising demand and supply constraints for safe havens. In the meantime, gold is still growing thanks to central bank purchases, safe haven flows, and a deteriorating macroeconomic environment. If recession worries materialize, it might reach $3,900. In an unpredictable global economy, both metals remain essential for investors seeking growth and safety. What possible effects might current tariff measures have on the equilibrium between the industrial demand for silver and its attractiveness to investors? If the need for manufacturing and renewable energy around the world recovers more quickly than anticipated, may silver's anticipated surge surpass gold's gains? Leave a comment below with your opinions. Please like this video and subscribe for future updates if you liked it. We appreciate you coming along on this adventure.
Same time U.S. declares silver as a national priority, you have Saudi Arabia buy a bunch in SLV. You see India's demand of silver is up 431% year over year in May, and record ETF inflows in June despite higher prices. So yeah, I mean, there's a lot of demand for physical metal that hasn't translated into the retail side of it yet. But the rest of the world, the big money, whether it be on the exchanges or the central banks or the sovereign wealth funds, are making it very clear that silver and gold are quite significant, and platinum, to their plans.
The U.S. has officially declared silver a national priority, signaling its rising strategic importance. At the same time, global demand is surging. Saudi Arabia has been buying large amounts through silver ETFs. India's silver demand jumped 431% year over year in May, and June saw record ETF inflows despite higher prices. While retail demand hasn't yet fully caught up, institutional investors, central banks, and sovereign wealth funds are clearly positioning silver. Andy is a well-known precious metals expert, CEO of Miles Franklin Precious Metals, points out that a large amount of gold and silver has recently flowed into COMEX, with September deliveries hitting 267,000 ounces of gold and 42 million ounces of silver, an unusually high figure. At the same time, short positions in SLV are surging, signaling major moves behind the scenes. The recent BRICS and Shanghai Cooperation Organization meetings also highlighted a geopolitical shift. Trump's threat of 50% tariffs on India seems to have backfired, since U.S. trade only makes up less than 3% of India's GDP. This is why leaders Xi, Modi, and Putin demonstrated unity at the SCO summit. Andy highlights that the SCO is not a minor group, it represents over 40% of the global population, 35% of global GDP, and nearly a quarter of the world's land area. Modi emphasized India's strategic autonomy, making it clear they will not sacrifice long-term interests. Meanwhile, China is investing in mandatory AI education from primary school upward, preparing its youth for technological dominance, while many Western youths focus on social media aspirations. This difference in priorities, combined with U.S. policy missteps, risks leaving America behind. Adding to that, U.S. stock valuations are now at record extremes, higher than even during the dot-com bubble and Great Depression, with investors heavily leveraged and exposed. Insiders appear to be exiting while the public piles in. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
A lot of gold and silver coming into the market, into COMEX. So far for September, 267,000 ounces delivered. 42 million ounces of silver delivered, which is huge. We talked about the shorts are up big time in SLV, which is huge. We talked about the BRICS meeting, the Shanghai Cooperation meeting. I think what I take away from that is that Trump overplayed his card with India, threatening 50% tariffs. When you look at the actual numbers, even though we are their largest trading partner, arguably, it only accounts for under 3% of their GDP, their trade with us. You look at a country like Mexico or Canada where it's the majority, that's different. We'll have greater weight. The purchase of Russian oil for India is far, far more important to them. And this is why you see Xi and Modi and Putin shake hands and smile and hug at the Shanghai Cooperation meeting. The SCO is no small organization. I've talked a lot about it on your show. It's over 40% of global population, 35% of global GDP, 24% of the land area. And so when you talk about takeaways, I think the fact that Modi stresses strategic autonomy, will not trade long-term interests for short-term appeasement. And, they're making stronger ties with Russia, with energy and defense and security. One of the things that I found interesting was that China is now embarking upon mandatory AI education from primary school, building all the way up through high school to build a AI talent pipeline. And so I found that to be very interesting. I also found it interesting that of all of the Gen Zs polled, that the number one job that came out on top wanting to be was a social influencer. And yet you have all of these kids in China that are becoming engineers and astronauts and becoming proficient in AI from elementary school on. These are the things we're getting left behind, whether it be in the way that our kids are being raised with education or what's happening in our U.S. foreign policy missteps under the Trump administration. As much as I would vote for him again, I think he really overplayed his hand with a country like India. And, I think that these are the kind of mistakes that are going to have ramifications with the continuing emergence and strengthening of not only the Shanghai Cooperation Organization, but the BRICS. We have not heard the end of that yet, but I found it interesting that more or less Modi came out and said, we're not going to back down from our relationship with Russia and or our oil purchases from them. It's more important than just about anything right now. So how this all plays out, I guess we'll see. But putting 50% tariffs on India was, I think, a big misstep. And that's what I took out of the Shanghai Cooperation Organization meeting. Other than that, like I said, likely to see payrolls be revised. I've read from anywhere from 500 to 800,000, which they will use to justify rate cuts. But when you have U.S. stock valuations now at the most expensive in history, surpassing the dot-com and pre-Great Depression levels, you got some serious risks ahead if indeed they do this, as the public is all in on equities, all in on margin, all in highest ever, and all in on options exposure highest ever. That's a dangerous market as the insiders are moving this way, the other way. So I don't know. It's not too much happened that is off the charts this week. I'm sure there will be by next week, but just more continuation of the same.
Andy explains that 8 major Western banks hold the largest concentrated silver positions ever seen on COMEX. This isn't just about controlling price. Though prices have been deliberately suppressed, it's mainly about maintaining access to silver stockpiles. Silver is unique because even tiny amounts are critical in high-value products, from cruise missiles to iPhones, so availability matters more than price. Rising prices would attract investor demand, but there isn't enough supply to meet it, which is why the market has been manipulated. Now, however, silver is recognized as a truly strategic metal. Although silver has risen to around $42 in mid-2025, a level many would have celebrated a year ago, analysts say this is just the beginning. With global players like Russia, India, Saudi Arabia, and China aggressively buying, and U.S. demand on COMEX also surging, the market is tightening. Once the retail side wakes up to this reality, shortages could spill over worldwide, and that's when silver prices may truly explode. For now, it's still an opportunity for early investors before the real fireworks begin. Now let's dive into the interview.
Banks, and I'll talk about Ed Steer's chart again that you showed several months ago. When you see 8 Western banks that maintain the largest concentrated position of any commodity ever traded on COMEX, it's not to hold down the price. Well, it is, but it's not price that's bothering them because silver is inelastic. You don't need a lot to make a very expensive item. Even if it's 500 ounces in a Tomahawk cruise missile that costs millions and millions of dollars, or a fifth of or a sixth or an eighth of an ounce in an iPhone, the cost of the finished product is so much higher than the little incremental price of silver. It doesn't matter. More along the lines of they've tried to step on it because rising price would attract demand. And there's not enough availability of it. The price has been skewed by the trading on COMEX and the LBMA. It's real value skewed. And so I think the rising price would attract investors, speculators. They don't want that. It's more along the lines of being able to access stockpiles of silver rather than the cost of the silver. I know that sounds kind of strange, but if you're making it for all of these critical components, it's less about the price and more about the availability because it's used in such small amounts in whatever the finished product is. But you're right. It has been suppressed. It has been held down. It has been manipulated. And I think now there's a race to accumulate it because indeed it is strategic. It is critical. It is needed not just in electronics and electrical components, just about anything that conducts electricity. It is needed in military components. It is needed in medical devices. It is needed in so many places, solar panels, etc. And that plurality of demand, from monetary demand to military demand to industrial demand, makes it strategic, every bit as strategic as any of these other strategic metals. And I think that's the change, is that Trump understands that, his administration understands it. So, yeah, this is something I think that will continue, and there will be at some point, I see a battle between the industrials and the, or shall I say, the manufacturers, the producers who need it, and the investors. So you're going to get companies like Tesla and Panasonic and Sony and whatnot in a battle for what's available. As the hedge funds and the investors start to take the other side, they're going to battle, and it's about availability of a depleting asset. It's not as much about the price, but just about the availability. And you start to wake everyone up just like that. It disappears. And what is a shortage on COMEX spills into a shortage globally across the board into retail as well. Not there yet. There's still great values, but I see that happening as where this ultimately goes to. But if I would have told people, a year ago that we'll be staring at $42, in early, mid 2025, I think most people would have been happy about that. Quite frankly, I think it's just beginning. We're a long ways away from seeing where this ultimately stops, but this is where it should have been a long time ago, and I think it's still got a lot of room to run based upon everything that I'm seeing, whether it be anecdotally or economically, or just by the movements of the biggest players in the world, with Russia and India and Saudi Arabia and China. They're all gobbling up silver as fast as they can. Evidently, so are the folks in the United States now, too, at least on the COMEX. When that translates to the retail side, which I believe it will, something will wake up the public, that's when we'll see real fireworks. And of course, we're not there yet, but that's a benefit to all of you who are trying to add to your portfolio before the prices get out of hand.
Silver's transformation from a quietly suppressed asset to a recognized strategic resource marks a turning point in global finance. With record institutional accumulation, geopolitical realignments, and growing industrial needs, the foundation is being set for a historic silver bull market. The window for early positioning is narrowing, as both governments and major investors move ahead of the public. How soon could retail investors begin to feel the global silver shortage already affecting institutions? Could U.S. policy missteps accelerate silver's role in a new multipolar financial system? Share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.
I think that the precious metals rally is saying that inflation was much higher than what the government was publishing in terms of CPI. The gold price is reflecting collapse in the purchasing power of money. And now the gold price is probably reflecting the cost of living increases between 1971 and today, rising strongly. So I wouldn't rule out that we could have gold and silver and platinum making short-term highs in the not too distant future. gold would be a reasonable alternative.
The recent rally in precious metals like gold, silver, and platinum likely reflects much higher real inflation than official CPI figures suggest. Since the US left the gold standard in 1971, the purchasing power of the dollar has collapsed, and gold's rise is tracking the true increase in the cost of living over time. Ray Dalio says markets risk a hard attack from rising debt costs in the US and suggests holding 10 to 15% of one's portfolio in gold as protection. Moreover, Goldman Sachs warns of this scenario. The idea is that political interference could damage trust in traditional assets and the dollar, making gold more attractive. In the near term, new highs in metal prices are possible, and gold remains a strong long-term store of value. The speaker, Dr. Mark Faber, often called Dr. Doom, is a Swiss investor, economist, and market commentator. Gold's rise since the US left the gold standard in 1971 reflects the loss of money's purchasing power and higher living costs. Markets don't move in straight lines, they surge, correct, then resume upward. Over 10 years, gold would be a strong long-term choice compared to stocks or bonds. Gold is up nearly 40% this year, outperforming most assets as Fed rate cuts, a weaker dollar, central bank buying, and inflation fears drive demand. Forecasts put gold between $3,700 and $4,000 by mid-2026. Treasuries remain debated, with long bonds seen as fragile, while short bonds or cash offer optionality. Still, gold and miners are favored amid economic and policy risks. In downturns, gold is viewed as insurance. Mark Faber specifically mentions the mining stocks like Barrick and Newmont. Barrick is streamlining by selling non-core assets to focus on top gold and copper projects, though production and regulatory risks remain. Analysts view it as undervalued. Newmont has been upgraded to outperform for its turnaround, strong cash flow, and leverage to rising gold prices. Both miners are seen with significant upside, potentially doubling if gold's rally continues. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the video.
The gold price is reflecting the collapse in the purchasing power of money since the US abandoned or exited the gold windows in 1971, August 1971, when gold was at $35. Now the gold price is probably reflecting the cost of living increases between 1971 and today by rising strongly. That would be my view. But as you know, markets don't move in a linear fashion. They move up strongly, then they overshoot, then they correct for a few years, and then they resume their upward trend. So I wouldn't rule out that we could have gold and silver and platinum making short-term highs in the not too distant future. That I wouldn't rule out. And equally, you know, if you ask me, Mark, you have to go to jail for 10 years. It's always a possibility. And then you have to invest your assets in one asset class and only one asset class. You cannot diversify. So you can choose properties, or you can choose stocks, or you can choose bonds, or you can choose gold. And you have to choose this and leave it until 10 years hence, 10 years later, when you get out of jail and want to collect your assets. In that case, what would you invest in? In stocks, bonds? I mean, I think gold would be a reasonable alternative. I mean, I've never been terribly keen about mining companies, but starting, say, about 9 months ago, I wrote that for the first time I was rather positive about mining companies because they were incredibly low compared to the price of gold, which had gone up substantially. The mining stocks hadn't gone up, but this year the mining stocks rose substantially. And I still like mining companies. I want to explain to you why I like mining companies. I think if you look at Barrick or Newmont Mining, the stocks have gone up, but they're not meaningfully up compared to previous highs. So I'd say this is a sector in the market. You asked me about value in the market, what it was desirable. I think mining stocks are very desirable. I think Barrick and Newmont, they can easily go up another 100%. I think US Treasuries is an alternative, not ideal, but say relatively favorable. And then cash is not a desirable investment, but it may be better than other assets in a downturn. You understand? You're not going to make money.
And it gives you optionality. You have optionality in case you have opportunity.
Yes. But my sense is that if everything goes down, I tell you, it will be very difficult for you not to lose money. But let's say everything goes down 50%. Like in the Depression, it went down everything 80% or so. In that case, you're the king if your portfolio only drops 20%.
Mm-hmm.
You understand? The market assets go down 80%. And you are among the fortunate ones where the asset value drops 20%.
Mark Faber points out that the dollar stayed strong until late 2014, mainly due to capital inflows, not fundamentals. Trump's policies weakened global confidence in the U.S. Meanwhile, the U.S. is in recession despite official denials. Recent analysis highlights that inflation remains sticky, with real interest rates often negative and underlying price pressures not fully reflected in official CPI data. At the same time, a weakening dollar, growing doubts about central bank independence, and geopolitical risks are driving investors toward precious metals. Gold, silver, and platinum are increasingly seen not just as profit opportunities but as safe havens and long-term stores of value. Now, let's just reflect on the interview.
The dollar has been exceptionally strong until November 2024. And it has weakened since then. And if you say, or if you argue that it was in the cards that the dollar would decline, then I agree. The dollar has been strong, but not based on fundamentals. It's been based on capital flows. In other words, the world moved capital into US assets, and so the currency remains strong. But I think Trump has done a lot to destroy to destroy the confidence people had in America. the bond market in the US should rally because we're heading into a recession. I think we're already in a recession, but of course, Trump and his henchmen will argue, no, we are doing extremely well. And the economy is exceeding expectations, and so forth and so on. But the reality is that if you look at the living standards of ordinary people, they're not doing well. No way. And the wealthy people, including myself and so forth, we benefited from asset appreciation and did very well in the last 30, 40 years. Ordinary people that have no assets, they've been hurt because the cost of living is going up much more than their salaries. So ordinary people get squeezed. And ordinary people is 70% of the US economy. There are instances where when they cut rates, the market goes up, and there are instances where it goes down, depending on the expectations that preceded the interest rate cut. But in the present situation, a 25 basis point cut wouldn't do anything. That is expected. 50 basis points, I think the bond market would react favorably, but not hugely. I mean, my view is the bond market will go and sell and trade until the yield on the 10 years is between 3 and 3.5%. Because I think the economy is much, much weaker than what the Trump team pretends it to be. Most people aren't doing well economically. Now, is Jeff Bezos doing well economically? Yes. There, say, 500 people in the US that do exceedingly well. There are another 10,000 people that do relatively well. And then there are zillions that don't do well.
Do you agree with Dr. Faber that gold is the most reliable long-term store of value compared to stocks or bonds? Could mining stocks like Barrick and Newmont really double in value if gold continues its upward trend? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.